Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Wednesday the 2nd of January 2019. I'm Darren Sinden and you can follow me throughout the day on Twitter by using @ds_Pepperstone. Right, let's kick off as ever with a look at the changes and the price moves to be aware of. But I thought we'd do something different. This is our first broadcast of 2019, and we take a look at the relative performance of a variety of asset classes over the last year, and just have a look at some of the factors behind that. First of all, heightened equity volatility, the VIX index, the measure of fear and greed, if you will, investor fear and greed among traders of US 500 equities, up by 110.89% over the course of 2018. A lot of that coming, of course, in the last 4 or 5 weeks of the year. In terms of currencies, it was a good year all round for the US dollar. Dollar index up by just over 4% as far as 2018 was concerned. Not so good, however, for the euro. The European single currency down by around 4.44% across the course of 2018. Pound sterling fared even worse, down by around 5.5% during 2018. It was also a pretty tough time for broad-based US equities. The Dow 30 down by 5.72%, the S&P 500 down by a whopping 6.25%. In terms of Asian equities, the Nikkei here, the Japanese 225 index, serves as a good proxy. That fell by 12.64% in 2018. But it was also a tough time for German equities. The DAX 30, the Germany 30 down by 18.45%. But crude oil had perhaps the toughest time of all, with Brent down by around 19%. West Texas Intermediate was off by just over 24%. So a mixed bag indeed in 2018. It will be very interesting to see what the trends will be as we progress through 2019, especially given the height of volatility that we saw just ahead of and just after the Christmas break. Okay, what's on the calendar? Events that may move the markets today. A pretty moderate calendar, I suppose we'll call it, in terms of the number of items on it. We've got holidays in New Zealand and Japan today. We've already had some key data out of China in the form of Caixin manufacturing PMI data for December, and we'll look at that in a bit more detail momentarily. To come today, we really get an update on the manufacturing sector across the globe with the release of market manufacturing PMI data from across Europe and the US, and we kick off at 8:15 with data out of Spain. That's followed by similar data from Italy at 8:45 GMT and at 8:50 GMT. The same data out of France. Then at 8:55, a look at how manufacturing has performed in the German economy throughout the month of December 2018, and that's followed at 9 o'clock by the data from across the whole of the Eurozone. So as ever, a chance perhaps to infer something in the wider Eurozone data from the German data released 5 minutes earlier. At 9:30, it's the time, or the turn I should say, of the UK to chime in with its market manufacturing PMI for December. And then we take a break, cross over the Atlantic, and at 13:55 we'll have the Red Book Index for December 28th, or the week of December 28th, out of the USA. And then at 14:30, Canada chimes in with its own version of the market manufacturing PMI report for December. And finally at 14:45, market manufacturing data for December out of the US. Now remember, of course, that these are leading indicators, the PMI data releases, and though they look back at what was going on in December, the market tends to take these as forward-looking indicators, and therefore what happens today in these numbers can and probably will influence people's outlook for the early part of 2019 at least. Okay then, breaking news and comment that's caught my eye overnight and over the weekend. And first of all, China's December manufacturing PMI has shown contraction in the world's second biggest economy, the data coming in at 49.7, below that 50 growth contraction boundary. The Caixin flash data, which is what we saw this morning, has followed official figures that released earlier in the week that showed a similar slowdown. So though the Caixin and the National Bureau of Statistics data doesn't always agree, in this instance they have done, and it does show manufacturing in China off to a slow start. Well, in fact, contracting as we enter 2019. Meanwhile, Donald Trump will meet today with congressional leaders to try and end the government shutdown and border wall impasse that has gripped the USA over the holiday period. And North Korean leader Kim Jong-un has said in a New Year's speech that he still wants to denuclearise and have a fresh summit with President Trump. However, continuing sanctions may force North Korea along a different path. So a sombre warning there from the North Korean leader as we start 2019. Right then, food for thought and something to take away with you into the trading day and beyond. And why not think about this? As we start the new year, it's interesting to look at people's opinions about global leadership and the roles of the US and China, which are of course the world's largest economies. The question I posed here is, how will the two superpowers fare in 2019? The top chart here, and both of these charts are from Pew Research, shows the confidence in Trump remain, and the fact that confidence in Trump remains low in European countries, although there has been a pickup more recently in confidence in Trump in the UK, but in Germany, France and Spain, for example, at very low levels. And then another chart here at the bottom just showing you how people view the relative roles and the power balance between the US and China, and where that stands relative to 10 years ago, which is the world's leading economic power now, and who would be better off leading the global economy and political scene. Okay, please take a moment to read this risk warning. Trading CFDs and foreign exchange on margin can be risky business. If you're in any doubt about those risks or the suitability of leverage products for you, then please do contact your Pepperstone account representative, and please do take the time to read this risk warning thoroughly. Thank you for your time today.